All right. So on November 14th, Foot Locker was at 31 or 30 even. Yeah, it was actually at 30.18, I think, when I entered this position. And so for today, I bought the 30 call and the 30 strike put. My debit was 390 into the position. Okay. So now let's take this here. We know what happened with the movement. Okay, so just jot this out. 30 and 30 was 390. That was my actual position. And enter that. Now on that same day, what I could have done is the strangle. Let's give ourselves some room. Enter the 28 put, let's just call it $1, and the 32, that's $1.10. Okay, so it would have been a 220 debit, or 210 debit, my apologies, a 210 debit with a 28 and 32 strangle. And we'll also give, naturally, a 210 credit for John for the short strangle. Okay. Now we know what's going to happen. What is long and short? Well, let's just enter it. Yeah, OTM Strangles plus. Let's enter in a long straddle first. My actual one was the Foot Locker today 30-30. Keep the math simple with one contract. I'll change the date, but don't really need it to matter, does it? All right. Okay. And so this was, what did I say, 390. So it was 190 here and about $2 on the put, I believe. I think it was 195 and no, it was 190 and $2. That's right. Okay. So there's my straddle on FL. The turn's about 178. So I got out a little bit early. Okay, I got out with a good price, 150% profit. We see there's at 178. Now, we know, of course, that the strangle would also be profitable. What's the strangle? Instead of buying at the same strikes on FL, we would have bought an out-of-the-money call and an out-of-the-money put. So we said we were going to buy the 28 put and the 32 call. All right, we're just going to add those in. And the prices we just saw in the historical chain was $1 and $1.10. Actually, I think I reversed them, but it's okay. It's the total cost is what matters at this point. Now, with this large move up on my strangle for Foot Locker, the turn's at 317%, so we could close it for 878. The initial net debit was only 210. Now, I don't need to put in the problem here. I mean, John knows this, and this is what he was talking about. So if John had done the short one, he might have gone further out even, maybe gotten a $1.10 premium. But if he was only expecting a 2 or 3 point move, and we see it up $9 today, so even if he went 4 strikes out of the money and went with a 26 put and a 34 call, he still would have gotten violated and had to pay it back. But on the reverse of that, I didn't do this straddle, but I could have, because AMAT had earnings today, as we just showed. It's in my married put. Married put play. We go back to yesterday on the historical chain for today's expiration. Now, if I had done a straddle, 58, Jesus, this would have been like 240. It was a $2.40. Yeah, it would have been about 245 midpoint if I got lucky to get filled at that at midpoint here. That's the bid and the ask. 123 bid, 365 ask on the put. So let's say I got in at 245, and I would have paid probably close to $1.40 here. So it'd be at 385, almost the same debit I had with Foot Locker. And of course today, remember those numbers on the 58 strike for today's expiration. And I probably would have even gotten a worse price of that with that kind of bid. Well, the stock's down to 56.49. 58 call goes right to zero. This goes to $1.45. So I paid $3.85 to get in, and I only get $1.45 back. I have a loss of $2.40 on that position. Okay, 68%, 70% of what I paid. Paid $3.85. got a loss of 240, so I'm about 70% loss on that one. Now, if it stayed up at 59 or gone to 61 and stayed there at the open, I'd have had 3 points back. I still wouldn't have been profitable, right? All right, but what does that mean? Well, that means John wouldn't have done the straddle. He would have done the strangle. So let's go back. And in John's case, he took a huge loss there, but here he could have done the 59 call for about 75 cents and done probably with the stock, I'm sorry, at 57.84, 58. So maybe he went 60, got about 65 cents there, and did the 55, maybe gotten 40 cents, so we've gotten $1 net credit. And then today, of course, with the stock at 56, both those would have expired worthless. Now, even if he did the 56 at 80 cents, well, okay, 65 cents. So if he got $1.30 for a short strangle, at 56, he still would have been looking pretty good. Everything would have expired there, and he would have had the profit. So it's a tale of two cities. Now, the reason why I bring it up that way, John, looking at those positions versus long and short, is to tell you the truth. My success rate so far on these straddles and strangles, these earning straddles mostly, has been around 50%, 52%, 55%, I think, on average. So in the past 8 months, yeah, 8 months, sorry, March is when I started. So in the past 8 months, I've been right with some profit. And the profit is all over the place, from 186% profits. I have had a 200% profit, 210% profit on that Red Robin. I've had a 3% profit, where the stock moved just enough to get a profit out of it of 10 cents on an investment of 210. So it's a 3% profit. But it'd be interesting to compare and say, well, if I had done the same thing with the shorts, and yes, occasionally taken a huge loss like I would have seen maybe today on Foot Locker, depending on your structure, but at the same time, would I have been profitable long term with the shorts over the long? And you might have different criteria you're using than I get into, because you might be focusing on a certain range out of the money and maybe a maximum net debit, or you have some, what would we call it, a expectancy equation that you're using as well. So maybe that's different, that you're getting into better stocks that are more conducive to short strangles at earnings, where mine, I'm really looking for gap up and gap down. And I usually get significant movement. Sometimes it's just not enough to counter the price I paid in. All right. All right, so let's go now to Rajiv's question. Rajiv is on Delta. D? D-A-L. Yeah, that's it, D-A-L. Okay. Actually, I'm just going to go to the custom spread tool again. So planning on a bit of a movement. Rajiv bought 2 51 strike calls for this November expiration. He bought this last week. So last week, he bought this November expiration, the 17th, 51 calls. Okay. So he sold both of those for a 10-cent credit because there was a spike yesterday. Okay, and he bought 151 call for the 24th of November for 38 cents. Okay. Well, okay, that's just a comment. Is there a question in there? Oh, is this a good way to manage expectation Delta will touch 55 during holiday season? Should I keep buying the call? Okay, so let me go back in time. And let's pull up, doesn't matter, but let's say a week ago we bought this at 28 cents, okay? Now, we know the gain and the profit loss of the long call. You're at 51. I mean, the stock was there. It came down. It spiked a little bit here 2 days ago. Let's go to 10-day chart. There we go. Oh. Sorry about that. There we go. All right, so it spiked up a little bit here. You thought it was going to continue, and I'm assuming that's when you bought this 51 call. Okay, so we bought the 51 call around this time when it was moving up, but it did the opposite. So you closed out of that. And now for next week, 7 days away on a shortened trading week, you bought another 51 call for about 38 cents, you said, okay? Now, you're asking me, is this a good way to manage? So we had a long call here. We essentially had to close it for near full loss because it did the opposite of you expected. And then you went back to a cheap out of the money call for next week's expiration, thinking that this is just an aberration and the stock's going to come back up with holiday season. You're asking me if it's a good way to manage. I wouldn't manage a long call this way. And Rajiv, we've talked about it before. We know that Sam kind of does this type of management. And we also commented last week that you guys both and a couple others that joined us for the Friday sessions trade much more actively and frequently than I do. But I don't think you're giving yourself enough time. I don't think 5-7 days is enough for the holiday traffic or holiday spike in travel to affect Delta stock. Personally, I'm not a stock analyst. I can't give you stock analyst advice. I'm not licensed to do that. Okay, but the key here is that I think it's too short term. I know it costs more to go further out in time, and I could say, well, if I bought this 51 call for 38 cents and it does go up to 52 by Wednesday of next week, well, this is going to be worth $1. I've got a 62-cent profit on a 38 investment, so it's almost a 200% gain. Whereas if you bought the January 52 call, or 51 call, I should say, it might be 110. And if it goes up to 52, well, it might only be worth 205. So you're only making 95 because there's a lag, because you had to pay more for the time value, and as it goes from out of the money to in the money, you might see a decline in the time value that you paid into. Okay, because it's going to be mostly intrinsic. I understand that you're looking for quick gains, quick options, cheap price. I just don't know if I'm wrong on my direction in this cycle, if just going out 7 days and keeping the same cycle is a good one. I probably would have, if I think the stock was going to pop next week, I might have gone with the 50 at this point, with the stock at 49.82. Why pay more price? Well, because if it moves up to 50.75, you're still losing a lot of time value on a shortened week. That's getting closer and closer to zero if it doesn't have the move you expected. Okay, but if I buy the 50 and it goes up to 50.50, if I paid 60 cents, well, I still might have 58 cents, so the loss is less. I just think managing it with an out-of-the-money call, short-term, continue to try to buy because you're waiting for a pop and it's not happening. You're buying week by week at the same or just out-of-the-money strike, and you keep losing on these because it's not moving as you expected. What's going to happen? Your annualized cost is going to be higher. So why so many investors are allured now, or I should say very interested in selling weekly credit spreads, weekly covered calls, okay, and things of that nature, is because if I sell week by week by week, we get the higher annualized return. The option that's 6 months out in time is not going to be 6 times the 1 month cost. And the option that's 4 weeks out in time is not 4 times the cost of the weekly option. So if I was able to sell, if Delta stayed right at 50 for 4 weeks, and I sold the at-the-money 50 strike for 30 cents, I'd get $1.20 after 4 weeks. Right now, the 1 month out, 15 of December expiration, is probably only trading at 105 or 110. Okay, so I'd get a better annualized return selling week by week by week. You pay a higher annualized cost buying week by week. And if there's not a catalyst, and I know your catalyst is the change in holiday travel, should spike the travel companies as well, then that's going to, I don't know if that's going to see that, okay? And I don't know if that's going to click in as fast there. And Sam thinks you should maybe, Sam suggests you maybe want to consider a debit, that you might want to do a debit spread of 53, 55, for example, to lower the cost. So give you a lower cost but a longer period to stay in the trade, looking at a debit spread further out in time, okay? And so that's a consideration. Rather than just buying a call, maybe doing a call debit spread to lower the cost, or a far out of the money, maybe even bear put debit spread. In that scenario where if it stays below 53, 55, you've got a lower cost than just buying the call or buying the put, and you can still make a reasonable profit. All right. Okay, so that's my thought on that. I don't like doing weekly long calls as I just don't feel it gives enough time. But yes, I say that, and let me put it a different way. If I'm bullish on a stock, I won't do weekly long calls. I'll likely do a married put. If I want to save capital and I feel really strongly now about maybe Google or Amazon or Priceline, naturally I'm buying a call because I'm not going to put up the $1,600, $1,700 per share for a Priceline stock. I'm going to buy a call instead. Okay, but I'm not going to do it week by week by week. I'm going to go at least 3 or 4 months out in time, maybe 5 or 6 months out in time, to give the stock time to move in my direction and to lower the time value decay. I mean, if the stock moves up 5, 6, 7% in the first 30 days, my leveraged long call is going to have a 15, 20, 30% profit, even though it's still out 5 months in time, because the time decay is not going to kick in really to that last 60 days. I'm going to gain intrinsic, I'm going to lose some time value, sure, but I'm still going to have a reasonable leveraged return. So I use it as a mimic of stock ownership rather than a quick hit of trying to buy a weekly call. Now, that being said, all of you can point out to me that, Mike, you sound like a hypocrite because you just went through a whole discussion on long straddles and long strangles. Yes, but I'm doing the long straddles and strangles only around an earnings, 2 or 3 days before earnings where the option expires that week, because I'm looking for the catalyst to move it 5, 6% one direction or the other. I don't care about the direction. I just need it to move 5, 6, 7% at least one direction or the other. That's how those are structured. The earnings is a catalyst. So, you know, if I'm thinking that the holiday season, DAL, is going to show some growth and it's going to be moving up in price, then yeah, I'd go to January. Well, it's unconfirmed, but it shows me that the earnings are 111. So I would probably buy a minimum of a January call looking for that type of pop. And if I don't get what I want in the first 45 days to January 11th or sometime around there, I might add a put to the position to go through earnings at that point. And sure, along the way I might, if it looks like the delta's stagnating, I might sell a call against my January call to create sort of a quick calendar spread to lower the cost. A debit spread, as Sam mentioned, but done in a diagonal form because I bought that January call. That's not trading advice. I can't tell you how to trade, and I'm not saying that I do have that anticipation for DAL. All I'm saying is that's why I like to buy the calls further out in time unless there's an earnings event. But as we just saw in the case of AMAT, there are times when I'll lose 70 to 80% of what I invest in a trade in 2 days. That's why with that earnings straddle I'm talking about, I only invest about 8% of my total portfolio. It's about 5. It's about 5% of my total portfolio value into 1 or 2 positions for the week. Because if one of them hits that full $100 loss, because the earnings did not cause the stock to move at all, then I still have money to trade. I've only taken out about 2.5% of my total portfolio, which I can stomach, and then try to build it back with the other positions. But I would have lost, as we saw, 70% if I played an AMAT straddle today, what I made on the Foot Locker one. Okay? That's the two out of 3 times that Foot Locker has actually given me more than a 90% profit on an earnings straddle over the last 3-4 quarters. The other time it was a loss of 65%. All right. So David came in with another strategy discussion. Not a strategy discussion, more of a market discussion. Okay. Now, I'm sorry, what he's asking is, where is a good place to find the top sector rankings and the top stocks in each sector? Okay, it's actually sort of a hidden link. It's not direct. Do I have it here? Yeah, top industry gainers. It's one of the available pods on the home menu. So all the pods, you can show pods for ex-dividends announced today, latest stock splits, recent site events, top industry gainers, top industry losers. Now, I know that's not exactly what you're looking for, but it's a starting point. All right, so we see here that today the only gainer was diversified machinery. But I can click on the link to see more industry gainers. And it shows me the apparel stores, sporting goods. These are the industry. The sector, of course, is basic materials and so forth. And you see the losers there as well. And so now I can go in here and take a look at basic materials. and then it shows me some of this information, but you can delve deeper into it. Okay, so this is just showing you the rank. It's not, this is actual alphabetical, but you can see here by the earnings per share growth range, the top sectors for which one has the most positive earnings per share growth. There's one, 10% for Persian Gold. All the others are kind of losses or zeros. 50% for Ring Energy, REI. But anytime you're in that stock research tool we saw earlier, David, there are some other links you might not know of that are hidden down here. And the one you want is, I think it's the optionable stocks in industry. Let's just take a look. Oh, no, that takes you back to here. Okay. One of those external links that was there, I apologize. It's not analyst estimates. It's not income statement. It's not cash flow. These take you to different pages. Oh, that goes to Yahoo Finance. That's not the one I want. I apologize. Let's see. Balance. Is it balance sheet? It's probably analyst estimates. I'm bouncing around here, and it's probably just the analyst estimates one. Let's see here. That one even works anymore. It was working the other day. But yeah, maybe that's not the one. Yeah, there it is. It goes to Zacks. I'm sorry. So when you're on the research page for the stock, let me show you that again. Whether you put in a stock and just click quotes, it takes you to this page. You have these external links down there. Click on analyst estimates. This takes you to a Zacks page, okay? And it shows you the Zacks ranking, of course. Oh, I'm sorry. And there's some, yeah, the industry rank, sector rank, and so forth. And if you go further down here, I think there's other comparisons that you can do on this page. You know, I just use this as an eyeball once in a while to see what it is. I don't always use that one. But I think that's the best way, David. Add that top stock gainers to your home tab. And once you've added that to your home tab, when you click on it, it'll show you the sector or industry gainers and losers. You can click on the specific sector, and it'll give you that breakdown that we saw in the optionable stock statistics page. Okay. And on the optionable stock statistics page, you could then quickly scroll through. I want to talk to Ernie about this. I would like this to be ordered differently. It's ordered by it's ordered alphabetically. I'd rather this be ordered by earnings per share growth, percent surprise, or just the static this quarter earnings per share growth. So that's a better gauge of strength of the stock. But again, click on the specific stock, China Green Agriculture. That takes you to the stock detail page. And from the stock detail page, go to analyst estimates. That gives you that Zacks page, which is usually a little bit more information there if you're interested in doing sector gainers, sector strength, and industry strength. We don't rate those by our own on PowerOptions, and we don't copy that over, but you can link to that Zacks page as well at any time. Okay. Oh yeah, Sam says it was surprising that some of these positions, the brick and mortar ones, brick and mortar companies like Abercrombie and Fitch, for example, showed such good earnings when they had such poor earnings last quarter, and the brick and mortar companies were kind of getting hurt. But another surprise was Ross Stores, or I'm sorry, not Ross Stores, ROST, which did pretty well. And Ross Stores last cycle, when all the brick and mortars were getting killed, it had a really positive earnings. So it's kind of interesting and refreshing when you think, oh, all the brick and mortars are going to collapse. If you played that one bearishly, you would have gotten hurt. So, and you also mentioned there that we like to, John mentioned, I'm sorry, that we like to go, for your short strangle, you go 2 times the long strangle price. Okay. All right, so you usually go 2 points out for the long strangle price, twice the amount. Okay. All right, and Sam just mentioned that he did a debit spread on Roku, similar to what Rajiv was talking about with DAL, but instead of going into the long call or long put, did a debit spread on the position as well. Let's see here, and Rajiv, going back to one more of his positions, I'm sorry, he said he also bought Apple Call for next week. Bought it for $44, 172.5 strike price. Okay, so you'll keep that until Friday. Okay, the call for next week. Okay. Yeah, sold on the morning pop, or Speculative position for Thanksgiving week. Okay, yeah. Now just remember, position sizing is important. What we're talking about there is buying a call on Apple at the 172.5 strike, and paid about, yeah, there you go, 172.5, about 44 cents. He went $44, 44 cents. And sure, it's at 170 now, but if there's a pop this week, it goes up to 173, 174. He's going to make a profit on the position. So it's a quick move play. But the important thing there, of course, where I was going is position sizing. And the key to that is the fact that, sure, it looks good to trade some of these lower price positions, 38 cents for a 1 week out call, 44 cents. But depending on your account size, naturally, you don't want to buy 50 contracts, 60 contracts, or 100 contracts. You want to keep the position size so if it doesn't go as you expected, and you take 80 to 90% loss of what you paid in that position, that you're only losing 2-3% of your portfolio at most. Okay, so every trade shouldn't have a risk of more than 2 or 3% of your total portfolio value in general. Now, speaking of which, yeah, and Sam says, well, yeah, no, that's me with 50 to 30 contracts. That's right, but you know, your larger account size there, so the 50 contracts for you. I'm talking about someone like me, you know, who's trading with essentially allocating $40,000 to options trading. So I don't want to do 80 contracts of one option at 44 cents there and represent too much of my total portfolio. Okay. Geez. Okay, let's see. And Sam closed his Apple one there. Rajiv says how to play the rumors, Discovery Communications, like Fox, the Disney discussion, and so forth. I mean, we could go down the rabbit hole. We really could. And I'm not trying to avoid your question. We could talk about, what was that person? What was a customer that emailed me the other day? Something I'd never heard of before. I'd heard of it, but never phrased this way. He asked me how he could search and identify a short call ladder position on a stock. I don't know what that is. So I had to look it up. And it's a really simple thing. I'm not saying to do this on something like Disney or Fox, but let's just take a look at it. So I'll do DIS. It's probably not going to be a good position, but I'll do DIS anyway. So the short call ladder strategy was one. I could do it different, but I'm going to do it this way. Yeah, this is going to be okay. I'm just going to do one contract of each. Okay. Oh, come on. Sorry, folks. All right, so what this is an at-the-money, the definition of it is really an at-the-money bear call spread with a further out-of-the-money call that's less than the initial net credit, so you end up with sort of a Big Dipper profit and loss chart. Really, it does looks better this way. Down, up, over, and that's infinite, okay? And they call this the short ladder. Well, I've seen this called many other things too. It's just a different phrase that someone's teaching it now as the short ladder. It has 3 other different names. It's just a bear call spread with an extra long call, but making sure that this long call's net credit is lower. So here we get an 80-cent net credit for the at-the-money bear call spread, but at the same time, we take 18 cents of that to buy another one to have unlimited further upside. And the idea, of course, is that, well, it's better than doing bear call spreads, because where do you get hurt? Oh, sorry, folks. Where do you get hurt on bear call spreads? Well, you get hurt when the stock goes up against you, right? There we go. You get hurt when the stock goes up against you. But here, with this ladder, this keeps going up. So if there's a sudden unexpected move and the stock goes to 109, you still have profit. But hey, if it stays down below here, as you know, if it falls further and moves down, you still make a profit. Your risk is in this area, which is probably in a normal market condition where most stocks will end up, in this case, in a 14-day trade, 75 to 80% of the time. You know, and there's ways you really want to sell this right at the money is how they teach it. And it's close. You know, the stock's at 103.44. So I did the 103, 105 bear spread and added a 107, or you can add a 108. And then if it really takes off, you can get the higher profit to the upside. Now, why do I bring this up? Is this a good way, you know, with this continuing up here, to play news, where if it doesn't move and it stays down, you make a profit, and if it does spike up on positive news, you get that upside profit? Sure. As long as that news comes to fruition in 14 days. If it doesn't, you've got the loss. If it stays between 104 and 108, essentially, you're in a loss zone. If it stays between 105 and 107, you're at the maximum loss if it doesn't happen in the first 8 to 10 days. So how long do you think? You know, you're talking about these rumors. What are the rumors with Discovery Communications, positive or negative? If you're basing it on a buyout or a takeover, how soon do you think that is likely to come into fruition, going through things such as, you know, the FCC rules, things of that nature, back and forth between the companies, another bidder coming in? Are you expecting it's going to happen in 5 days, you're going to see a gap? Or are you expecting that, you know, the market knows these rumors are happening, maybe some spike has already been priced into one of those two, and then it might have a collapse later, which in this case, this would be good. You'd still make a profit. Or why complicate it? Now, sure, this gives you a chance to win on the downside with a limited profit, gives you unlimited upside profit potential. Net credit right away, 69 cents, 70 cents in this case, but it's still a monetary risk of 130, the difference in the strike prices. So instead of complicating it, I think rumors are going to come out one direction or the other. Remember, the max risk was what, 130? And you're taking a credit of 69 cents. Okay, so now I've doubled that to 234, but if it falls this way with the straddle or this way, moves up for positive news or moves down, I have infinite profit one direction or the other. Of course, the risk is double, but I'm going to practice proper position sizing, where if I did that short call ladder, the big dipper profit and loss chart is what I call it, my risk would have been 130. All right, so if I wanted to risk 1% of my total portfolio in the worst case scenario, I would have done 3 contracts. Okay, in this case with the risk at 234, if I want to keep it under 1%, I have to do 1 contract. We're talking about a $40,000 account, let's say. Or I could take it a little bit above and do 2 contracts. So if it just stayed right at 104 and didn't move in 14 days, that the action I'm taking doesn't come to fruition, then do it that way. But I could continue this path, okay? And what I mean is I could show you ratio spreads, back spreads, ratio back reverse spreads, back put spreads, ratio back put spreads. We could talk about double diagonals. We could talk about what John was talking about, saying, well, I know there's news and rumors of news on this position, and I think it might swing one way or the other. Well, even in the positive news, if I think, well, you know what, it's not strong enough to move, I don't think that news is going to move at 10% or more, we might do what John did, and we could do the short strangle, where if it does gap 20% or 25%, we have that maximum risk, infinite risk to the upside on the short side. So why do I suggest straddles or strangles? And Rajiv says, better buy, you could buy an OTM January or March call for just 60 or 80 cents, sure. And then you could buy a call and a put out in time, okay? And then, now we're talking about other comments are coming in, okay? And so that's kind of the idea. And we could go, I mentioned again, is that, we could go down the rabbit hole. You could take the same question, and this is nothing against them at all, but you could go to, what is it, Tasty Trade, watch their live presentations they do during the day. And you could ask them, if they took your question, you could say, well, how would I do that? Now, Tom Sosnoff, more experienced trader than I am, absolutely, in options and other things. Great guy, great educator, in my opinion. He really knows his stuff. He could probably give you 3 to 4 different strategies to play. And they might be ratio spreads, they might be something else. he might just say, based on news, you might just want to trade a collar. I mean, sometimes that's what I tell people too. I might just do a collar on the position. Why do something so simple? Well, because if it goes up 10 or 15%, I make 3%. And if it drops down 20% because the news didn't come to fruition, I lose 4%. I know I'm proper position size from the beginning, okay, without having to count how many contracts I should or shouldn't trade if nothing happens. He might even have other ideas. Okay? And Rajiv says he has a Tasty Trade account. You'll email them. Well, let me know what they say. And I'm not going to steal their ideas. I'm just curious. Okay, so I said, you know, you're expecting news one way or the other. Think a long straddle or a long strangle. Sam says, take it a different way. Go with the out-of-the-money call and put for a cheaper price, maybe 60 or 80 cents, and go out to January or March, planning on a big move, but giving yourself the time. As I mentioned, this is probably too close for me. It's not an earnings play, right? It's a rumor play. And if it doesn't come to fruition in 14 days, I'm burned. I brought that other position into play because you'd say, well, if I'm right and the stock falls, I want to make money. And if I'm right and the stock moves up, I want to make a lot of money. Well, that's what this ladder call spread is. And this is why people do the ratio back spreads, where you end up with a profit and loss chart of something like this. Okay, so you get a small profit of 10 or 15 cents if the stock falls. Your max risk is right here, kind of like this short ladder collar, though this is more of a gap. And then you still have the infinite upside. So if it's positive and you expect it, you make a great return on all three. If it's negative, you make a little return, make a lot of return. Risk is higher here, almost double, okay? Then that Big Dipper profit and loss chart. And, you know, the profit here for the other one would probably go like this, the ratio back spread. Probably look something like that. I was comparing the three together. So all different ways. And then, of course, we, you know, say, John, if, you know, we didn't think it was going to drop below 89 even with negative news not coming out or go above 114, maybe we do a far out short strangle. It's not my play because I don't like the infinite risk, the upside or the downside. But again, if it stays here, making a really good profit, you know? And that, so what's the way to play it? I don't know. Everyone's going to give different ways. This comes down to your risk-reward tolerance, what you're willing to trade, and what you're comfortable with. I bring it up because I think this short, I see the benefits of it, but I think it's complicating an issue. Okay? I want more something that looks like this. Keep it simple. Buy and buy. That's what does it. Why throw in extra short legs here, long legs here, buy one that's only 15 days out and buy the other, you know, buy an out-of-the-money call that's 15 days out and buy an out-of-the-money put that's 3 months out. Okay. Why complicate it? Keep it simple, keep the expirations even, okay? But again, other investors are more successful than I am, I'm sure. Okay, there's something there. Let me see if it's done yet. Speaking of success, I had an interesting discussion here this week. Perfect. I'm going to have to write some of this up, and I don't have the slides with me, unfortunately, for Monday's presentation. Wednesday's presentation, I'm sorry, ladies and gentlemen. So Wednesday's webinar, we discussed, let me copy that there before I forget it. On Wednesday's webinar, we were discussing just using the PowerOptions search tool. It's archived. And at one point, there was a screenshot where I showed the picks of the day results. Let me go back to custom spreads. Give me the most white space here. Sorry. So we discussed the picks of the day for the covered call weekly, naked put weekly, and the bull put weekly. Oh, I'm bringing this up real quick for a specific reason. The bull put weekly search, the default search that eventually is going to be the bull put picks of the day. So when you go to covered call, you see the picks of the day and so forth. Okay, but the bull put weekly from May 22nd of 15 to, I think it was September 18th, or maybe I went to October on this, but it's irrelevant. But 28 months, essentially. It was an 84.5% return with, I believe, about an 84 or 89% success rate on trades. It was 240 trades done over that period. let's see, is every other week, 28 months? Yeah, it's about 240, 260. 84.5% return, about 90%, 88% success rate or something like that. The portfolio went from $100,000 on 5/22 to 184.5K. That's where that 84.5% return comes in. Okay, now, why am I bringing this up? I had a gentleman asking me the other day, I was talking about the radioactive trading techniques. My annual goal with the limited risk positions paying for the insurance is about 10 to 12% annualized return. Some years I make more, some years I make a little bit less. Okay, but I think on average I should say, been about 10 to 12% with the radioactive trading techniques. And of course, he throws this back in my face, not meaning to be negative, but he says that makes no sense. Why would you continue to trade a strategy that makes that little money when you're showing positions in bull puts the last 28 months have made 84%? You should just have all your money in bull put spreads. The answer to that is no, because in some months I'm opening 3 or 4 positions as part of the trading plan. In some months, 3 of the 4 trades would go against me. That's the nature of spread trades, just a sudden decline on a 10 or 14-day trade, and you're at full loss before you know it, even avoiding earnings. Well, if I allocated everything into that and hit one of those months, I'm down 75% of my total portfolio value. It's going to take me forever to recover from that, even with that success rate. Position sizing. This 184,000 was done over a 28-month period, but only 20,000 of this 20%, following the Kelly criterion for investing, was invested into the bull puts. Okay, so we're only taking 20%. So if we had one of those bad months and lost everything, we've only lost 20% of our trading capital. My personal portfolio, about 15% or so, is allocated to credit spreads. Now, where am I going with all this? Because I just finished a test and I wanted to see this. And he said, well, how can you say then that the best expectations may be around 10 or 12 or 15% annualized return? I said, well, yeah, this last 2 years were all better with bullish strategies. But if I had traded a bullish strategy from 2006 until today with the same exact criteria and same exact management techniques, I wouldn't get 85% return year after year. Some of those years are going to be losses because the market is dynamic and ever-changing. As it turns out, I just did that the Bull Put Weekly default screen, and I ran it from January 1st, 2007 through October 20th, 2017, so October expiration. And I'm just looking at the final results here. I can't copy and paste it there for you. Oh yeah, I can. Hold on one second, folks. Okay, sorry, let me do it this way. I'll just... Okay, there we go. Sorry, give me 1 second, folks. There we go. All right. There we go. Okay. So from the bull put credit spreads from 1/1/2007 to 10/20/2017, the ending cash on hand, starting with, again, same principles, $100,000, and allocating only 20% of that to the top 3 trades in each cycle, weekly, 2 weeks out. So 6.67% of entire capital invested into each trade, and only taking the top 3 trades, over 10 years, 152.8%. 508 wins, 36 losses, 93% success rate. Okay, this just finished. I was running in the background while we were doing this. Now, the average return on the winner was 6.8%, and the average on the losses, 7% of the time, is 53.6%. Okay, 10 years, though, 152.8. What is my annualized return over 10 years? 15%. 15.3% per year, right? We look at it that way. This includes the 2-year cycle, 28-month cycle that gave us an 85% return. That's in there. So you see, that's where I was getting at, is that in different market conditions, same strategy will do better. This is okay. 152.8% return. Had I been trading just bull puts, following the criteria I created, allocated $20,000 into that account, I would have made $152,000 profit, right? So the total account went up to $252,831. A lot of commission prices in there, of course. We'd have to factor that in also. But 152.8% over a 10-year period. Of course, we started in 2007, which included 2008. We know what happened there. We know what happened in some of the other cycles. But 10 years, 152.8% return, sounds great. What's the average? 15.3% per year annualized return. Over the last, let's just say 2 years, instead of 28 months, let's say the last 2 years, this strategy was offering 40% per year, right? It's or 42% per year. It's up 84.5% over a 28-month period. So the last 2 years, bull put credits following the criteria average 42.5% per year. But take any strategy long term. I don't care if you're doing straddles. I don't care if you're doing strangles. I don't care if you're doing married puts, collar spreads, wins and losses. If you just keep one strategy and one strategy only in your portfolio, Ernie and I always say this, and we've always felt this, that your average should expect to be 10 to 15% return per year on average in every strategy once you average in the winners and losers. Okay? No one I know, there's 1 or 2 customers I know, and they're successful, averaging about 15% to 20% per year. I have one customer, very intelligent gentleman, very smart, asks a lot of great questions about the tools, offers a lot of great suggestions. All he does is cash secured naked puts. Weekly, monthly, whatever, 2 weeks out, monthly, around earnings, not around earnings. That's all he does. Consistent 15 to 20% returns. So why don't you do something else? Why? He's got it. He's making it. That's his goal. And he's doing well. That is very good, by the way, for an investment portfolio. 15% per year, 10% per year is fantastic. 12, 15% is fantastic. He does better than I do long term. I think he's closer to 15 to 18% per year with naked puts. I have another customer who just trades covered calls. At any given time he calls up to ask a question. Yeah, he still calls and asks a question. He might have 35 to 40 different covered calls in his portfolio. And I can't manage that many in my own personal mind, but he does really well. Some of them are 3 months out in time. Some of them are 8 months out in time. But it's okay. He's just looking to make that average. And I think his is lower. He is looking for an average of 8 or 9% per year. My key is they do really well with it. They've mastered those ones there, okay? And that's great and that's fantastic. And as I mentioned, at times they do better than I do. I adjust. I move strategies. I keep 40 to 50% of my portfolio in the married puts, yes. But I'll switch from calendar calls to calendar puts based on market sentiment, from bull puts to bear calls or bear put debits based on market sentiment. I'll still do straddles around earnings with only 5-10% of my total portfolio, but I'm doing different strategies, okay? But on average, this is the expectation. And even though this one strategy, and this is what I always tell customers that call up, you guys know, you've all been there. Ladies and gentlemen, you all know, you've all seen it. There's a lot of advertisements out there for buying long options that can make you 300, 400%. Hey, we just made 600% on our last 3 trade selections for the 15-day time period. Of course you did. Of course you did. What about the other 20 positions that were open 3 months before then? What about the other 20 positions that are going to be open 3 months after that? If you take 80 to 70% losses on those, you're right back to square one with the 3 positions that totaled 600%. You know, that's the lie of leverage. Okay, so over time, one strategy, factoring in winners and losers, even with management techniques, This does not include management techniques, by the way. This is not taking into account rolling or adjusting the 36 positions that hit a loss. But you see it, even factoring wins and losers, over time, 10 years, 15.3%. This will probably go higher, by the way, because if I keep this through January, going through January for a full 10 years to January 1st, I'd expect this to go up to maybe 161, 164% if the market continues. If the market continues. But if not, then that's okay. But aside from that, that's the average. The bull put credit spreads, the weekly covered calls, picks of the day, the weekly naked put picks of the day. Very strong returns over the last 28 months. Break it down year by year and take all of them the 10-year period. They probably averaged 15, 18, maybe 12% returns. That's still good. Don't get me wrong. This is still fantastic over a 10-year period. But again, some of the years were losers. Some of the years it lost money. Some of the years it only made 6%. The first year, 2007, the bull put weekly only made 6%. The account went from $100,000 with allocating $26,000 up to $106,000. We made 6%. Nowhere near 40%, but half of the average that you expect. Okay? So I'm going to have more on that later in the week. Not this week. I'm going to have more of that the first week of December. We're going to do a presentation on expectations, strategy expectations, and more. Sort of a follow-up to what we did Wednesday with just the search tools. Okay? All right. Let's see here. Rajiv says, do you have any strategy for cryptocurrency trading? No, I do not. I personally stay away from it myself. I don't know anyone who trades it. I don't know who to even recommend to go out on the market, or go out on the internet, or go out on the market and look for someone who has advice on it that's probably not trying to sell you something. Okay, so I can't help you with that. I don't touch cryptocurrencies right now. I don't know if I ever will. I understand the concepts behind it, of course. I just don't think it's something I'd be comfortable trading because I don't know enough about it, and I don't know how much to really hedge it in case of any kind of movement. I don't know how to hedge it and how it works that way. All right, just a reminder to everyone, of course, if you haven't yet, remember, just go to PowerOp.com. On the right-hand side, you will see the field there to put in your first name, last name, and email address. Just put in your information, and you'll have access to a free 14-day free trial to test out the tools with the 20-minute delayed quotes as well. Of course, the subscription levels after that, lowest subscription level, end-of-day date is at $40 per month, and then the delayed is $60 and more. The other free stuff, of course, remember, you can always check out our blog at blog.powerop.com. The webinar archives, you can always check those out, powerop.com/webinars.asp, and also check out our YouTube channel as well. In addition, if you think of a question later on, remember, send me an email at any time, support@powerop.com. If you have questions about married puts, you can reach us to support@radioactivetrading.com. Please remember, you can feel free to call us at office hours at any time at 302-992-7971, and trial members and subscribers can schedule a coaching session at any time as well. David said, I would like to hear more on calendar calls. I will try to log in on the next expiration for the answer. Okay. Okay, that sounds good, David, if you can make it. I do have a webinar there just on the introduction to calendar spreads and the criteria for calendar spreads. We're going to enhance that a little bit upcoming. For those of you that are regulars, Rajiv and Sam just mentioned it, everyone have a happy Thanksgiving and have a great trading shortened week next week. Market's closed on Thursday, half day on Friday. We will not be here. I will not be here. We will not be doing a Friday webinar next week, of course, because it's a half day and the markets close at 1. So next Friday, no open discussion presentation. We'll be back on December 1st at 4:30 p.m. Eastern Time. Ladies and gentlemen, thank you again for your great questions. Thank you for joining me today, and thank you for sticking with me through my little diatribe there about using one strategy long-term and how it still matches the expectations of that 12 to 15%, even though you can see a 1 or 2 year period where you had an 80, 100, or 50% return. Doesn't mean you're getting 50% return every year. Market is dynamic. Market's changing as well. So keep that in mind. But take care, everyone. We'll have more on that for you later. As well as David H. asked, we'll have more on those calendars coming up as well, and some other things coming up later on in this week also. later on in the month also, so through December. Take care, everyone. Have a great night. We'll talk to you soon. Bye-bye.